when you buy and flip, you're buying a distressed asset more often than not. You're putting some money into it in the form of a rehab, and then hopefully you got enough equity at the top that you can sell it for a profit, right? When you do the buy and rent, similar strategy. More often than not, you're still buying a somewhat distressed property. You're putting some funds into it, and then what differs is what's your exit strategy.
My name is Scott Hampton. That's the name of my phone. I'm sorry. But however, good afternoon, everybody, and good morning, wherever you are. My main question is I'm just looking to decipher the difference behind the thought process of buy and hold versus buy and flip.
Great question, Scott. So the primary difference is when you buy and flip, you're buying a distressed asset more often than not. You're putting some money into it in the form of a rehab, and then hopefully you got enough equity at the top that you can sell it for a profit, right? When you do the buy and rent, similar strategy. More often than not, you're still buying a somewhat distressed property. You're putting some funds into it, and then what differs is what's your exit strategy. So in some cases, you can do what's called a cash out refinance. If there's enough equity there, you can then. So let's just say I give you real numbers. I just did three of these. I don't know, last month. So I bought a property for 75,000. I put 25,000 into it, right? So I was all in at 100,000. The property appraised is after repair value, which is synonymous with projected sales price. It appraised for 200,000. So I mean, I had $100,000 worth of equity in the property. So the bank in this particular case would give me an 80% cash out refinance. Okay, but instead of taking 80% out, we took like 75% out. So we took out like 150,000. So I was able to put $50,000 tax free in my pocket because it was a cash out refinance. That money is tax free because technically it's a loan, although you putting cash in your pocket. This is the power of real estate. Now, had I did that same thing and flipped that property for the 200,000, and let's just say I would have made, net of fees, I'd have made about 65, 70,000. I would have had to pay what's called capital gains tax on that money. And I know this is going like next level already, but I'd be remiss to not take it there because this is the difference in strategy in that you could have a property that you could very easily sell and make 70 some thousand, or you can keep it and put $50,000 tax-free money in your pocket. Which one would you choose to do? It's not a right or wrong answer. It's just really based off of what your goals are. For me, I everything is cash flow for me now, right? I'm at this season of my life. That's just what makes sense. I started out that way, didn't have the tools and the mentorship and the resources, aborted that plan, started flipping and wholesaling, nothing wrong with it. But now I'm back at a different season, where I'm more focused on cash flow, net worth, and that sort of thing. And so I really don't look at any deal as a flip opportunity. I may acknowledge that it's there, but I'd rather do a cash out refinance, put the money in my pocket. Does that make sense?
That absolutely makes sense. It's time to get this money.
Yes, sir. If I'm not mistaken, Scott, you got a contracting company, is that correct?
Yes, I'm a licensed builder. Yes, I do a lot of
Okay,
lot of
licensed
rehab
builder,
work.
my man. Okay, beautiful, beautiful. So let me ask you this: are you ready to fire yourself from that when you start? And I mean specifically in your investment properties.
Absolutely. I mean, my personal strategy for my first flips are to eliminate the cost of contractors, the labor portion of it.
Right, right. And so it's going to be interesting to see as this week plays out because we work with a lot of contractors. And oftentimes they think I can control my costs, I can eliminate the labor costs. And that may make sense, but this is what I would say to that. On one hand, if you got a project that you can put your crew into and you can go and make 30, 40%, right, as a GC on that deal, Does it make more sense to have them working inside of your project where you controlling labor costs, but you missing out on that opportunity, as opposed to if you can go and bring in another crew because you know what you can hold them more accountable. You're not working inside your own project, and now that business Cadillacing, and then now you got this business also Cadillacing, and you got two different entities doing two different things at the very same time.